Hi, I'm Jonathan Shepard from the University of Kentucky, Department of Agricultural Economics in the College of Agricultural Food and Environment. Today I'm going to deliver a video to you on income statement basics for new beef producers. This is part of our Beef Business Foundation videos for new beef producers funded by the Ag Development Fund through the Kentucky Beef Network. In short, we're simply going to talk about what an income statement is and how we use it. The income statement is one of the three most important financial documents that you can have for your farm business. The other two being the balance sheet, which is covered in a different video, and a statement of cash flows, which will be in an upcoming video. The income statement is essential for obtaining loans and for you to understand what the financial health and profitability of your company is. The income statement summarizes the financial happenings of the business over its accounting period. This typically is a calendar year for most producers. Another way to say this is that the income statement tells the story, or is the narrative, between what happened at the end of last year, which would be the beginning of this year, and the end of this year. In other words, it bridges the gap between your beginning of your balance sheet and your end of your balance sheet, and precisely tells how net worth was affected and why. One concept we have to discuss is accrual accounting versus cash accounting. For all intents and purposes, your Schedule F, which is where you report your income and expenses for tax reporting purposes as a farmer, is a cash income statement for most farmers. Most farmers are like to be treated as cash basis taxpayers, and as a result, that Schedule F is essentially a cash income statement. There are some cases where farmers choose to be taxed on an accrual basis, and I'm not addressing those limited number of farmers in this video. The problem with cash accounting is that it does not account for things such as inventory value changes, accounts receivable, accounts payable, etc. It is ill-advised to use a cash income statement to make management decisions because it does not necessarily reflect what the profitability was for that given operation during that time period. It is true that compiling an accrual income statement or an accrual adjusted income statement is more time consuming than a cash income statement, but the results and information that you can get from it are far outweigh the time associated with completing it. I should also mention that there are some cases where a Schedule F or a cash income statement will very closely match or exactly match an accrual adjusted or an accrual income statement. Those cases are arguably far and few between because most farmers have inventory that they hold from one accounting period to the other, especially in livestock, and accounting for those inventory value changes is very important and not captured on a cash income statement. Another key difference between cash and accrual accounting is that with cash accounting, revenues and expenses are recorded in the time period that they occurred, whereas with accrual accounting, revenues and expenses are, quote, matched or, quote, pinned to the production period that they occurred. This distinction between cash and accrual is very important for most farmers because oftentimes there is revenue that is generated in one accounting period but not actually sold and realized until a following accounting period. For example, if we look at a cow-calf operation, calves born in a given year are not accounted for as income until the year they are sold under a cash accounting system. Whereas in an accrual accounting system, the value of the calves are accounted for on the income statement in the year in which the value was created. Here's a very simplified example of a cash versus an accrual farm. So we have Farm A and Farm B, and you will notice that both farms had cash receipts of $400,000, cash expenses of $300,000, and depreciation expense of $50,000. From a cash accounting, the cash income would be exactly the same for both of these farms at $50,000. Simply the $400,000 in revenue less the $300,000 in actual expenses and $50,000 in depreciation expenses. However, if we had accounted for the inventory value change of these two farms, and in this example we're assuming that Farm A had a positive inventory value change over that 12-month period of $100,000 versus Farm B having a value change of $100,000, but in the other direction, you can see that the accrual adjusted income is very different, with Farm A's income being $150,000 and Farm B's income actually being negative $50,000. Once again, if you simply looked at this from the cash accounting side, the Schedule F of these two farms would be identical and they both would be paying taxes on $50,000 worth of income. But for management decisions, it's easy to see that in both cases, management decisions could be bad or limited or ill-advised, not understanding that one farm actually made $150,000 and the other one lost $50,000. Great, now what? We know what an income statement is, but how do we use this income statement to understand our financial position or our financial health? So there are several metrics that we can get from this one document. One is income from operations, which is also known as net farm income. One is rate of return on assets, rate of return on equity, the operating profit margin ratio, and the asset turnover ratio. Income from operations, or net farm income, as some of you may know it by, is just the difference between your total revenue and your total expenses, and a positive number indicates a profit was made and a negative number indicates a loss was realized. The next two measures, rate of return on assets and rate of return on equity, are also profitability measures that look at how the business is using its assets to increase profitability. It's important to remember that rate of return on assets or even rate of return on equity is better to be looked at over time within a business as opposed to comparing across businesses. But it looks at how efficiently the business is using its assets to create profit. We also have the operating profit margin ratio as a profitability measure, which simply allows you to calculate how much of each dollar that you bring into the business are you actually keeping as profit. The last but not least measure of profitability is the asset turnover ratio, which looks at how a business is using its assets to generate revenues. There is a distinct difference between the asset turnover ratio and the rate of return on assets, in that the rate of return on asset looks at it from a net income perspective, and the asset turnover ratio, while different, the key difference is that it looks at it from a revenue generation perspective and how assets are used to generate revenue and not just net income. Understanding how to complete or construct an income statement understandably could seem daunting to producers, but it is something that there are a lot of resources out there for. We could spend several videos walking through the proper way to create an income statement. I encourage all producers who are interested in learning more about the income statement or how to create their own to consult a lot of the resources that are free and available out there. Your local cooperative extension service is a great source. Lenders can be of significant help. The Farm Financial Standards Council is another source of information that farmers can turn to understand in more detail how to create their own income statement, what pieces of the puzzle need to be included, and resultantly what information can be derived from that, the calculations behind some of these, and interpretations as well.